You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. Today, we are looking at a global market that is really caught in a strange tug-of-war.
It really is. On one side, you have this hawkish shock coming out of Australia, and on the other,
A complete information blackout in the United States.
Yeah.
Exactly. While the Reserve Bank of Australia delivered its first rate hike in over 2 years, this partial U.S. government shutdown is leaving traders flying blind without those critical labor market reports.
So today we're going to break down why the Aussie dollar is outperforming, what's happening with oil and this new U.S.-India dynamic.
And why metals like gold and copper are staging such a massive rebound. Let's get into it.
It's a fascinating setup this week. You have, extreme clarity on one side of the Pacific, maybe more than borrowers wanted, and then total fog on the other side.
I want to start with that clarity because, frankly, it caught a lot of people off guard. We're talking the Reserve Bank of Australia.
Right.
They raised the cash rate by 25 basis points to 3.85%. Now, for anyone just casually watching, 25 basis points might sound, pretty standard.
But the context is everything here.
It's everything.
This is the first hike in more than 2 years. I mean, think about the psychological shift that represents. For the last 6 months, the whole global conversation has been about the pivot.
When a rate's coming down, how fast?
Exactly. And then the Reserve Bank of Australia comes out and says, actually, we aren't done going up.
And it wasn't a split decision, was it? Usually with a move like this, you'd expect a divided board.
That's the part that really woke the market up. The decision was unanimous.
Wow.
This wasn't some case of a few hawks winning an argument. This was the entire board collectively recognizing that the inflation problem just isn't solved yet.
So what are they seeing that maybe the market was ignoring? Because we keep hearing about this global disinflation narrative.
Well, they looked past the headline numbers and they focused on the sticky stuff, the underlying inflation.
Okay.
They explicitly said that inflation is likely to remain above target for some time. They're looking at the core pressures, and underlying inflation rose to 3.4%.
And 3.4% is obviously higher than their target band.
It's uncomfortable, and it was higher than they expected 3 months ago. When the data keeps beating your own forecasts to the upside, a central bank, well, it loses the luxury of waiting. You have to act.
And the governor, Michelle Bullock, she was pretty direct about it.
Incredibly direct. She used a phrase that really struck me. She said, the pulse of inflation is too strong.
That is a very vivid way to put it. It sounds almost medical.
It's effectively a diagnosis. And she made the point, which is crucial for you to understand, that while high interest rates are painful for people with mortgages, entrenched inflation is painful for absolutely everyone.
It erodes everything.
It erodes wages, savings, purchasing power. The Reserve Bank of Australia is choosing the acute pain of a rate hike now to avoid the chronic disease of high inflation later.
But here's the part that seems counterintuitive. Usually you hike rates because the economy is overheating. But is the Australian economy really running that hot? I saw GDP grew by 2.1%.
It's not a runaway boom, no. But private demand is growing faster than expected. The real story, though, is the labor market. Unemployment is stable at around 4.25%.
So people have jobs, they have income, and they're spending.
Exactly. And that creates capacity pressure. It's a recipe for what economists call sticky inflation. And the market reaction was immediate.
I saw the charts for the Aussie dollar. It looked like a rocket launch against the U.S. dollar.
It's the standout performer globally. Just days ago, the market was pricing in cuts. Now, Governor Bullock is saying she doesn't even know if this is the start of a new tightening cycle, but she can't rule anything out.
She's keeping the door open for more hikes.
Explicitly. And that kind of uncertainty is terrifying for a homeowner, but for a currency trader looking for yield, it's incredibly attractive.
Okay, so Australia is providing plenty of clarity. Let's flip over to the United States, where it feels like someone just turned off the lights.
It's a bit of a black box right now.
This partial U.S. government shutdown. The issue for the markets is data, isn't it?
It's the fuel the market runs on. Specifically, the Bureau of Labor Statistics has delayed the JOLTS report, and of course, the big one, the January employment report.
Let's just pause on JOLTS for a second. Why does the market care so much about that specific report?
JOLTS stands for Job Openings and Labor Turnover Survey. It basically tells you how many help wanted signs are out there. The Federal Reserve watches this religiously.
Because if openings are high, wages go up, and then inflation.
Exactly. It's a key forward-looking indicator. And the January employment report, well, that's the non-farm payrolls, the big one. Without those two, the Fed is trying to fly a complex machine without its instrument panel.
So what does a trader do? Just guess.
You sit on your hands. We're seeing a classic holding pattern. The risk backdrop is constructive. People aren't panicking, but they're incredibly cautious. You don't make a massive bet when the scorecard is missing.
But we are getting some signals, right, from the private sector.
Yeah, the engine is still running. We got the ISM manufacturing survey from the Institute for Supply Management, and their data suggests U.S. growth momentum is still intact. We aren't seeing a stall.
And in corporate earnings, too. I was looking at Palantir this morning.
A significant move there. Palantir showed standout strength after their Q4 results, and that helps support the tone for the NASDAQ for tech stocks. It tells us that even in this macro fog, companies that execute well still get rewarded.
So the micro story is decent, but the macro story is missing. What about the U.S. dollar in all this?
Surprisingly, it's been remarkably contained. The U.S. dollar index is trading broadly flat.
Why isn't it dropping if there's no data to support it?
Because, relatively speaking, the U.S. still has a growth advantage. The consensus is the U.S. economy is holding up better than, say, Europe or Japan. But again, without the hard numbers, traders are really reluctant to chase any momentum.
It's a waiting game. Okay, let's pivot to a market that hates waiting: commodities.
And oil in particular, always the most volatile room in the house.
It feels like oil has been on a roller coaster. We had that huge geopolitical spike, and now WTI and Brent crude are hovering in the low to mid-60s.
They're stabilizing, yeah. The aggressive geopolitical premium, the extra cost you pay because you're scared of a war, has unwound a bit. The market panicked, then realized the actual physical supply hadn't been cut off.
And we even heard some reassuring words from Russia.
We did. Russia's Deputy Prime Minister Alexander Novak mentioned a surplus in fuel supplies. When a major producer says, "We have plenty of fuel," it calms the nerves.
But then, just when you think the story is simple, we get a curveball. The U.S. president announced a new trade deal with India.
This is the headline that had everyone scratching their heads.
And part of that deal, apparently, involves India stopping its imports of Russian oil.
For the last few years, India has been the single biggest safety valve for Russian crude. They've been buying up what Europe and the U.S. sanctioned.
So if India stops buying, where does that oil go?
Well, that's the billion-dollar question. This is what we call a change in the demand routing story. The oil doesn't just vanish. Russia will have to find new buyers.
Maybe China takes more. Or it goes into the shadow fleet.
Probably both. But it adds cost and friction. It absolutely alters the leverage of sanctions. If India really does stop, Russia loses its best customer. That hurts.
If they stop. Because the reporting here is conflicting, isn't it?
Massively. The White House says the deal is done, but the Kremlin came out almost immediately and said, "We haven't heard anything about this."
So who do you believe?
Well, the market is stuck right in the middle. Until we see the actual tanker tracking data change, until we see ships physically turning around, there's going to be a lot of skepticism.
Right. It could just be rhetoric for now.
It could be. We just don't know yet.
It's amazing how politics and physics collide in the energy markets. But oil isn't the only commodity making moves. Let's talk about metals.
A very strong correction and rebound moment.
Gold took a beating recently, dropping to around $4,400 an ounce. But now it's back up near $4,900. It's a serious recovery.
It is. And the speed of that bounce tells you something about investor psychology. The drop wasn't seen as the end of the bull run. It was viewed as a sale.
A buying opportunity.
Exactly. Investors saw the price drop and thought, great, a chance to buy the dip. The floor here is really central bank buying. They want assets that aren't tied to the U.S. dollar, and that puts a floor under the price.
And it's not just gold. Copper's rebounding too, around $13,480 per ton. They call it Dr. Copper for a reason, right?
That's the old rule, yeah. It supposedly has a PhD in economics, but there's a very specific catalyst here involving China.
I saw reports about China expanding its strategic copper reserves.
Yes, and this is significant. China treats base metals like the U.S. treats oil with its strategic reserve. They're looking at a commercial reserve system with state-owned firms.
Why does that matter to a trader in New York?
2 reasons. First, Simple supply and demand. If China, the world's biggest consumer, starts filling up its warehouses, that's a huge buy order. It drives the price up.
And the second reason?
It's a policy signal. It suggests Beijing thinks current prices are a good long-term buying opportunity. And we saw another subtle signal from them. They just raised gasoline and diesel prices.
Which implies they think their own consumers can handle it.
Exactly. You don't raise fuel prices in a collapsing economy. It's a small vote of confidence in their own domestic activity.
Okay, let's zoom out from the charts for a minute and look at the broader geopolitical map. It still feels incredibly tense.
It's a confusing mix of kinetic violence and diplomatic whispers.
On one hand, you have reports of loud explosions in Kyiv. The war is still very hot.
The kinetic risk is absolutely real. But at the same time, the Financial Times is reporting on a multi-tier plan for a ceasefire. The U.S. president is hinting at good news.
It's schizophrenic. The signals are completely contradictory.
They are. You have peace talks on one side, and on the other, Russia's deputy foreign minister is saying the modernization of their nuclear triad is at a very advanced stage.
Nuclear triad. That is not a casual phrase.
Not at all. It's classic signaling. We might be talking peace, but don't forget we have the big guns, and you see the same kind of dynamic in the Middle East.
Right. The tone seems slightly less explosive than last week.
Marginally. Iran is unveiling new nuclear achievements, which is, concerning. But then an Iranian official notes the U.S. aircraft carrier has pulled back near Yemen, and the U.S. president confirmed talks are ongoing.
So, steps forward, steps back.
It's a holding pattern of tension.
Before we wrap up, a quick look at Europe and Japan. The euro is kind of just floating.
The euro is flat. We saw cooler than expected French inflation, which is good for the European Central Bank, but not enough to drive a big currency move. And sterling is just waiting for the Bank of England.
Japan, though, seems to be getting interesting again. The yen is soft.
It's entirely political right now. The focus is on the upcoming Sunday election and talk of a potential supermajority for the Liberal Democratic Party.
And the market thinks a supermajority means a weaker yen.
Well, there's some confusion around Prime Minister Takaichi's comments on the currency. Her team had to clarify she wasn't endorsing weakness, but the market's not fully buying it. The uncertainty is keeping the yen heavy for now.
So bring it all back home. We have Australia hiking, the U.S. in a data blackout, commodities bouncing, and geopolitics whispering about both peace and war. What is the big takeaway for our listeners this week?
So what here is that the macro narrative, the story of global growth, is actually coherent. It's there. We see in Australia and the U.S. ISM data, even in China's copper buying, the global engine is working.
The car is moving forward.
The car is moving forward, but the dashboard is broken. The U.S. shutdown smashed the speedometer and the heel gauge.
That is a dangerous way to drive.
It is. And because of that, traders are willing to buy the dips on growth signals, but they're going to be incredibly twitchy. They'll cut their exposure very quickly if a bad headline flares up.
Because they don't have that hard data to anchor their confidence.
Precisely. So you have to watch the speakers. We have Federal Reserve officials Bowman and Barkin and ECB President Lagarde. In a data vacuum like this, their words carry double the weight.
It's going to be a week of reading tea leaves, for sure.
And keeping one eye on the news ticker.
Here's a final thought for you to chew on. We're all assuming that when the U.S. government reopens and the data finally comes out, it'll confirm what we think we know, that the economy is fine. But what if the dashboard lights turn back on and the engine light is flashing red?
That is the risk we're all running.
Thanks for listening to the Financial Source podcast. See you next time.
That's it for today. Thanks for being here. We'll catch you in the next one.